Hey, and welcome to Talk Tickers. This is your rapid intel stream where we take the latest earnings calls and really deep dive into what actually matters.
Exactly. We cut through all the noise to give you the key insights. Think of it as your shortcut to being properly informed on what these companies are telling investors.
Right. And today we're digging into the Cracker Barrel fiscal 2025 third quarter earnings call.
Yep, we've listened through it, pulled out the essentials. This covers our quarter that ended back on May 2nd, 2025.
So what's the plan for this deep dive? Well, we're going to hit you with the headline numbers first.
Then we'll look at how the quarter actually played out, the ups and downs.
Dig into some of the details behind that performance, talk about the strategic moves they're making.
And then take a look at what they're forecasting for the rest of their fiscal year. Sound good?
Sounds great. Let's start with that quick snapshot. Q3 results.
Okay, big picture. Total revenue hit $821.1 million.
Which is up slightly, right? Just barely.
Yeah, just 0.5%, 0.5% compared to the same time last year.
Okay. And if we break that down, the restaurant side.
Restaurant revenue did a bit better. It was up 1.2%, landing at $679.3 million.
But the other side, the retail part, the front porch store.
That saw a bit of a dip. Retail revenue actually decreased 2.7% year over year, came in at $141.8 million.
And you kind of see that same story in their comparable store sales, don't you?
Exactly. Comp restaurant sales, they grew 1%.
And that's significant because...
Well, it's their fourth consecutive quarter of positive comp growth on the restaurant side. That's a trend management definitely highlighted. They seemed pretty pleased.
Right. But on the flip side, the retail comps.
Those were down. Decreased 3.8% for the quarter.
Okay. How about profitability? Adjusted earnings.
Adjusted earnings per diluted share came in at $0.58.
And adjusted EBITDA?
That landed at $48.1 million. Now, that works out to 5.9% of total revenue.
Which is basically flat compared to last year.
Pretty much identical. It was $47.9 million or 5.9% last year, too. So margin percentage held steady there.
So what was the general vibe from management on the call?
Overall, pretty positive, actually. They said they were pleased with Q3, even mentioned it exceeded their own expectations.
Okay.
And they feel it really underscores that their big transformation plan is, working. This is despite admitting the quarter got off to a bit of a soft start.
Okay, let's unpack that softer start. What happened there? February was tough.
Yeah, they mentioned February was challenging, pointed to, some bad weather, maybe some lingering consumer uncertainty playing a role.
So how did they react to that slow beginning?
Right. They said they took pretty swift action, proactively put steps in place to support the top line, the sales, and also really manage expenses tightly.
Trying to navigate that headwind without messing up Q4 plans?
Exactly. Didn't want Q3's softness to derail things later.
And off-premise sales, takeout delivery, still important.
Definitely. It was 19.1% of their restaurant sales in Q3. That's actually a little tick up from 18.9% the year before. People still want those pancakes to go.
Yeah. Speaking of food, what were they highlighting on the menu in Q3? Anything specific helping drive that restaurant side?
They had a spring promotion with a couple of shrimp dishes, something Louisiana style, and a shrimp and grits skillet.
Okay, shrimp.
And they also expanded their pancake options, added new flavors, different price points.
Oh, that sounds like that barbell strategy they talk about.
Exactly. Offering both value stuff and more premium items, trying to appeal to everyone, basically.
Makes sense. So beyond the food, any operational stuff they talked about? Kitchen improvements?
Yes, and this feels pretty key. They rolled out phase 1 of what they call their back of house, or BOH, optimization, system-wide in Q3.
BOH optimization, phase 1, what does that actually mean?
It's mostly about simplifying processes, making things in the kitchen more efficient, aiming for better food quality, more consistency.
And easier for the staff too, presumably?
Yeah, making the job easier, which hopefully boosts profitability in the end.
Are they seeing results from that yet?
Seems like it. They reported hourly employee turnover improved quite a bit, down about 14 percentage points compared to last year's Q3.
Wow, 14 points is huge in this industry.
It really is. And their internal scores, like employee sentiment, those were up 2.3% too.
So happier staff staying longer? That's got to help the guest experience too, right?
You'd certainly think so. A smoother kitchen usually means better service out front.
Okay, let's switch gears to the costs. Cost of goods sold, COGS, how did that look?
Total COGS was 30.1% of revenue. That's up just a tiny bit from 30% last year.
And if you just look at the restaurant side?
Restaurant COGS was 26.2% of restaurant sales, up from 25.9%. They said this was mostly menu mix people buying slightly pricier things and commodity inflation.
Inflation hitting food costs. What specifically?
Yeah, commodity inflation overall was about 2.9%. Main culprits were higher prices for beef, eggs, and pork.
Oof. Anything helping offset that?
A little bit. Produce and poultry prices were actually lower. They did mention a temporary spike in spot egg prices because of avian flu hitting a supplier,
Right, I heard about that.
but those prices apparently moderated later in the quarter.
Okay. What about the retail COGS? The store stuff.
Retail COGS was 48.9% of retail sales. That's actually slightly down from 49% last year.
How'd they manage that?
Better vendor allowances, basically negotiating better deals with suppliers, though they did have to take some higher markdowns on inventory, which offset some of the gain.
Gotcha. Now the big one, labor costs. How did that shake out?
Labor and related expenses came in at 37.1% of revenue.
How does that compare?
That's actually down nicely from 37.8% the year before, a 70 basis point improvement.
Nice. What drove that improvement? Was it that BOH stuff?
Partly, yeah. They credited leverage from menu pricing flowing through, plus improved productivity, especially from that BOH optimization.
So efficiency gains helping offset wage increases.
Exactly. They mentioned hourly wage inflation was running around 1.9%, so those productivity gains were crucial.
Okay. Any other big expense lines, other operating expenses?
Those were up. 25.3% of revenue versus 24.5% last year. They said it was mainly higher advertising spend pushing the brand and more depreciation.
Makes sense if they're investing. And G&A, general and admin.
G&A was 5.6% of revenue, up a bit from an adjusted 5.4% last year. They directly tied that increase to investments needed for their strategic transformation plan.
Right, that transformation costs money up front. Okay, balance sheet check, capital spending, debt.
Q3 capital expenditures were $36.6 million. Total debt at the end of the quarter stood at $489.4 million.
Any changes to their debt facilities?
Yeah, they didn't update refreshed their revolver and added something called a delayed draw term loan, a DDTL.
Okay, and the point of that is?
More flexibility. It boosts their total debt capacity up to $800 million from $700 million. Gives them breathing room, especially looking ahead to refinancing a $300 million loan that's due in June 2026.
Smart planning. And dividends for shareholders.
Still paying one. The board declared a regular quarterly dividend, $2.25 per share, payable in August to shareholders of record in July.
Okay, let's look forward now. The transformation plan and what's happening in Q4, the current quarter, big focus seems to be on brand refinement.
Yeah, they talked quite a bit about that, said it's building steam now in Q4 with the official launch plan for August.
So what does brand refinement actually mean? Just a new logo?
Doesn't sound like it's just cosmetic. They talked about evolving the brand across all the places guests interact with it, trying to create deeper engagement.
Like updated advertising, showing up differently.
Exactly, a new look and feel, but also showing up in places that feel, quote, authentic to Cracker Barrel.
Any examples of that authentic presence?
They pointed to their recent NASCAR partnership. They sponsored the Cracker Barrel 400 race, doing activations all summer.
NASCAR. Interesting. Why that?
They see a strong overlap. Their guests and NASCAR fans, they argued, share values around experiences, country hospitality. Seems like a logical fit from their perspective.
Okay, what about on the food side for Q4? Anything big?
Oh, yeah. Big news here is the return of Campfire meals.
Campfire meals. I remember those. They've been gone a while, right?
Since 2018, management said they've gotten tons of requests from guests and employees to bring them back. Apparently, it was a very popular item.
So what's coming back? Same old stuff.
They've got the favorites, the beef and chicken versions, but also a new shrimp and andouille sausage option.
Nice.
And they stressed they've worked on elevating the flavors, improving quality, and making them easier for the kitchen to execute.
Easier for the kitchen is key. And the price.
Starting at $10.99, so hitting that value note again. And they're backing it with marketing that reflects that new brand refinement look.
That $10.99 price point feels important right now.
Okay, what else?
Social media?
Loyalty. Yep, evolving social media, working with creators more. And the loyalty program, Cracker Barrel Rewards, that's still a huge focus. Driving visits, engagement.
How's that program doing?
They hit a big milestone, reached their fiscal 2025 target of 8 million members already during Q3.
8 million. Wow.
Yeah, it's significant penetration. They said over a third of their track sales are now tied to loyalty members, and it's driving incremental business.
Any tech involved there? AI, maybe?
Funny you should ask, yes. They're testing an AI-driven personalization model with rewards, using AI to tailor offers.
Seriously? How's that going?
Early days, but they sounded pretty encouraged. Said tests are showing a mid-single-digit lift in average revenue per member compared to the control group.
Mid-single digits. That's not trivial if it scales.
Definitely not. And AI is popping up elsewhere, too.
Oh, yeah. Like where?
They mentioned using machine learning for better traffic forecasting, which helps with labor scheduling. An AI filter for guest relations calls to speed things up, even using it in cybersecurity.
So they're actively looking for ways to use AI?
Seems like it. Evaluating opportunities where it makes sense for efficiency or the guest experience.
Okay, now, the less positive stuff. Tariffs, China. How's that impacting them?
Yeah, that's a headwind. About a third of their retail stuff is sourced directly from China, plus indirect exposure too.
So what's the plan? How did they mitigate that?
It's a few things. First, tough negotiations with vendors. Second, looking for alternative sourcing locations.
Moving production out of China.
Exploring it, yeah. Pricing is the last resort, especially for retail, because value is so important there.
So they don't want to just pass the cost on.
They want to be really cautious about that. They're also accelerating some existing retail strategies to help, like reducing the number of items, less reliance on seasonal themes, changing promotions.
Trying to simplify and reduce exposure that way.
Right. But they admitted the situation is dynamic. Expect more details on the fiscal 26 impact come September.
Okay, let's pull back. Investor context. How did management frame the current situation, Q4 specifically?
They described the start to Q4, the quarter we're in now, as strong. Said they were pleased with the improvement they're seeing.
And they tied that to?
Specifically called out those Campfire meals resonating really well. Didn't give a hard Q4 comp number, but the tone was definitely that trends improved from Q3.
Got it. What about expenses going forward? Still managing tightly?
Well, they were tight in Q3, pulled back on some discretionary G&A, shifted project timing. For Q4, they expect G&A to look more like Q1, Q2 levels, partly because those shifted projects are happening now.
So G&A might look higher in Q4.
As a percentage of sales, maybe closer to the start of the year, but they stressed FY25 is an investment year. The goal is for G&A percentage to come back down closer to historical levels in future years. More on that in September, too.
Okay. Pricing and average check. Any changes there?
Pricing guidance for the year is still about 5%. In Q3, the average check was actually up 6.6%.
Whoa, higher than the pricing. How?
Right, it was 4.9% from pure price, plus a positive 1.7% from menu mix.
Ah, people ordering more expensive things again.
Exactly. Management slipped happy that pricing stuck, and they got that mixed benefit from those higher-end barbell items, the steak and shrimp, pot roast, that shepherd's pie thing.
But they expect that mixed benefit to moderate a bit in Q4.
Yeah, just because the comparison to last year's Q4 is tougher on the mix front.
Okay, so thinking about margins improving, how are they doing that with tariffs and inflation still around?
They pointed to a few drivers: continued menu mix benefits, those labor gains from lower turnover, and the BOH rollout kicking in more.
Okay.
And actually, slightly better egg prices expected in Q4 than they first thought, which helps offset some tariff impact. But the big message was the underlying structural improvement from the transformation plan really starting to show up.
The payoff from the test and learn year, as they put it.
Exactly.
Let's quickly go back to that BOH optimization. Phase 1 was Q3. What comes next?
Right. Phase 1 was process simplification. Savings should flow more in Q4 and FY26. It's part of that bigger $50-60 million cost save target.
And phase 2 and 3?
Phase 2 later on involves using more pre-prepped ingredients like pre-chopped veggies. Phase 3, further out, is about equipment solutions. It's a multi-year rollout.
Aiming for permanent cost structure improvements in food and labor.
That's the goal. Improving total prime cost, even if the savings shift between the food bucket and the labor bucket.
What about the store remodels? Any updates there?
FY25 is the test year for that, too. They've done 20 remodels and 20 refreshes. Feedback is positive, lighter, brighter stores.
Okay.
And they actually launched a new version of the remodel design late in April. Very early days, but early results sound promising. Apparently takes a different approach to the retail section.
More details coming in September on that, too.
Yep, September seems like it'll be a big update call. They want more time to learn from these tests before laying out the FY26 plan.
Okay, last thing on trends. Traffic. Q3 was challenged, but what's the underlying story?
Yeah, overall Q3 traffic wasn't great, but they emphasized the trend improved through the quarter. February was soft weather, uncertainty, but March and April got better.
Leading into that strong Q4 start they mentioned.
Exactly. They also said they looked at demographics, age, income, and didn't see any major shifts causing the Q3 softness. It seemed broad-based.
So they're framing Q3 as more of a blip, a speed bump.
That's the term they used, yeah. Expressed confidence in the long-term direction and their ability to bend the curves as the transformation plan takes hold.
Okay, interesting stuff. It is now time for our segment where we float a potential market idea. But first, the important disclaimer.
Absolutely. This is Talk Tickers.
All right.
All the information we're discussing today is for informational purposes only. Definitely not financial advice. We're just breaking down the call for you. Please consult with a professional for any investment decisions.
Couldn't have said it better myself. Okay, with that very clear, let's think about an outrageous but plausible trade idea based on this call.
All right. We heard management raise guidance. We heard Q4 started strong, thanks to things like Campfire meals.
Yeah.
Loyalty's growing, AI is showing early promise.
Plus those structural cost improvements from BOH and active work on tariff mitigation.
The whole narrative feels like one of building momentum, right? A plan starting to work despite the headwinds.
So, the outrageous but plausible idea. Maybe, just maybe, a bullish stance. Betting that this Q4 momentum carries into fiscal 26 even stronger than maybe management will initially guide to in September.
Interesting. So you're betting on the upside surprise after the initial FY26 guidance.
Kind of. The rationale would be perhaps the tariff hit isn't quite as bad as feared because their mitigation works better or faster than expected.
Okay.
And you combine that with the benefits from the transformation, like those BOH savings, or the AI and loyalty accelerating faster than projected.
So the BOH savings flow through quicker, the AI loyalty boost gets bigger.
Yeah. Essentially, you'd be betting that Q3 was just that speed bump, and the underlying improvements gain steam rapidly in FY26, leading to potential upward revisions later in the year.
It's definitely playing the things get better faster angle. Plausible, given the positive signals, but outrageous because it requires outperforming potentially cautious initial guidance.
Exactly. Okay, let's wrap this deep dive up. Key takeaways.
Cracker Barrel's Q3 results beat their own expectations. Restaurant comps were positive for the fourth straight quarter.
The transformation plan seems to be delivering tangible results, brand work, operational efficiencies like BOH, tech integration with AI.
Initiatives like bringing back Campfire meals are clearly resonating and drove a strong start to Q4.
And all that led them to raise their full-year adjusted EBITDA guidance, even with those tariff clouds looming.
Yeah, management definitely sounded confident that the plan is working, and they're building momentum for fiscal 26.
All right, well, that's our deep dive into the Cracker Barrel Q3 call.
Remember, everything discussed here was for informational purposes, not financial advice.
Thanks for tuning into Talk Tickers. We'll catch you on the next one.